Hey, welcome everybody to the Presidio Perspective. I'm Dustin TenBroeck.
And I'm Luke Jacobson.
Glad that you guys are with us here for another round. We got a busy show today. Lots are happening right in front of our eyes that, luckily we had kind of teed up to talk to you about today. So we have our first segment, our first topic of the day is the market drop. We were supposedly talking about last week, but hey, why not make it today, Luke? So the same kind of factors at play. So Luke and I are going to talk to you a little bit about that, what's going on, what our perspective is there. We also have a new stimulus bill that's unfolding in real time in front of our eyes with recent changes as far as just a few hours ago. And then we also have some economic data that's come out, revisions on that are going to affect our gross domestic product and what our views are of the overall economy. Kind of a market wrap up of some of the other things that we're looking at from the days, weeks, months ahead that are going to be pretty important. So shall we get into it?
Yeah, let's get right into it.
How are you doing, by the way, Luke? Are you good today?
Yeah, I think I'm doing okay today. I mean,
you look good.
Well, thank you. I appreciate that.
Yeah.
It's kind of we're experiencing what markets feel like, right?
Yeah.
Like everything doesn't go up forever. We do experience volatility, and so in a sense, it feels a little more normal than it did when everything was headed to the moon for week after week after week. So, so that the return to normalcy, obviously the market is having a panic attack about that. But you know who's not having a panic attack about it?
You?
No, not me.
Yeah,
Jerome
I know
Powell.
you.
Jerome Powell
Okay.
is not having a panic attack about it. So
Yeah.
we can maybe we dig in with how important that is.
Okay.
And things that happened across the globe as it relates to interest rates, currencies, Jerome Powell, Janet Yellen, Joe Biden, all that.
Yeah, that's good. And I want to come back to that at the end about feeling good with the market down and what you mean there because I get it.
Yeah.
I think we should end on that today.
Okay.
But yeah, what are your thoughts? What does Jerome Powell see, and why don't a lot of the people in the market see the same thing, or why are they concerned about it?
Well, there's a debate about interest rates versus asset prices, right? So right now, when we walked in here, I believe the interest rates were the 10-year U.S. 10-year was at 1.55, 1.54. And let's talk about the catalyst that really kicked off a rise in rates last Thursday. So we had a 7-year bond auction that had a demand, also known as the bid to cover ratio, that was less than normal. Typically it's, say, 5-6x, and it was 2x. So the demand was lower than normal, and because of that, prices dipped and rates went up. Maybe you can explain how that works in bonds.
Yeah, so again, something that we understand about bonds is there is an interest rate that they pay, right? A coupon payment, so some guaranteed rate, and then that's based on a certain price. And so the rate and the price have an inverse relationship. So as prices fall, interest rates go up, and vice versa, right? Mm-hmm. As interest rates fall, prices of bonds go up. And so there's a lot of factors at play, some of which we cover when we talk about, what the Fed is going to do with interest rates, right? And they affect the short-term end of the curve of how long those maturities are. So really short-term overnight lending, the Fed has a lot of control, which could ripple through the rest of the interest rates. The other thing is supply and demand. Do people want to buy the bond at the current interest rate? So there's a lot of governments who are forced to buy their bonds all the time, right? Kind of like our Social Security Administration laws, where we have to, fund it with U.S. Treasuries, is how you have to fund Social Security. So there's kind of a built-in mandate to buy Treasuries. But we've been looking at astronomically low rates for a long time and thinking, who the heck wants to buy something that's 10, 20, 30 years in the future and only make 1%? Looking over the pond at Europe, how would anybody want to buy something that is going to pay them a negative yield that's going to be worth less than 10 years on a guaranteed basis, right? So we've kind of been in this bubble where we're waiting for it to, and a bubble is probably a good term, right, of the 35-year bond bull market, which we talked about last episode. So when that demand does not show up, right, what do you do if nobody makes a bid on your home, right? You list your house You got no bids. What is the realtor coming to talk to you about?
We're going to have to lower the price.
We got to lower the price, right? And so that's what happens at a federal auction for our treasuries.
That's right.
Everyone shows up to bid. Price is too high, meaning the rate is too low. You need to drop the price to make a higher interest rate. So now people are interested in buying those bonds. And so small movements, right, can have magnified effects on our economy, especially when you're dealing with, a rate as low as 1.4 as it was last week.
Right. So it was 1.4. And let's just add a level of context about changes in rates and the appropriate comfort level that the market has with changes in rates. So I think it always comes back to a lot of individuals have mortgages, and they can understand in their head what an 1/8-point change in rate will do to probably the cost of their mortgage as rates went down. So, and they have an idea of what that change in rate would have to their price. And the market has the same concept as it relates to all sorts of debt securities that reverberate through the globe. And so that's a really complex way of saying a really basic concept, which is a 2/8 change in rates is a dramatic change in the cost of debt. And so when we have a rate of change of 20 basis points in the 10-year from 1.4 to 1.6, basically overnight, stemming from the 7-year bond auction that we just talked about, that sends ripples not only through the U.S. economy, but also across the globe. And so responses that happened across the globe from that major change last year or last week was that Australia and Japan, who have caps on their rates, made significant federal open market operations to cap the change in rate, while the U.S. sat back and said, nothing to see here, everything's great.
Right.
So Jerome Powell basically looked at a CPI report last week that showed a 1.4% rate of change and saw a massive spike in rates a few days later and said, I'm great. Like, we don't need to do anything here. We are going to keep rates really, really low, and we're going to let the rate of inflation continue to move higher, as he said, for the last 12 months plus.
Right.
We're going to let rates move higher. In fact, they changed their stated inflation expectations to a cap of 2 to an average of 2. Mm-hmm. So he's looking at 1.4% rate of change and saying that's half of where he wants it to be.
So so are you switching now to 1.4 rate of change on inflation?
On inflation,
right?
Correct. So
pretty close to the 10-year, right?
That's right.
But so if you have an average of 2, and you just did a 1.4% number, right? If you're gonna post up to a 2.6 inflation rate, right? Mm-hmm. That's gonna bring you back to the average of 2, meaning it could essentially double.
Correct.
Inflation could essentially double, and the Fed and Jerome Powell say, yeah, that's right in line with our policy.
Right. And so the market, by digesting this information the way it's doing, is effectively, you're getting kind of in the bond vigilante world, where does the Fed control long-term interest rates? Does the bond market control long-term interest rates? How does that work? And to go back to the original comment of Australia and Japan, Australia and Japan have said, we are going to do what we have to do to control long-term interest rates. And the bond market here in the United States is kind of giving messages to Jerome, listening to his set of expectations. We would like you to control long-term rates too. Mm-hmm. And he's setting expectations that he doesn't think is necessary. And this kind of gets into that kind of third dimension of setting expectations and beating expectations is just as important as setting policy itself. If you kind of think back to probably the times where you might be sleeping through your macroeconomics class, setting expectations and beating expectations is a huge tool for the Federal Open Market Committee.
Yep.
And that's what he's really doing right now, is trying to hold a really strong line and say, don't see it, we're going to let things grow, things are going to be great.
Yeah, and so, I mean, I think going back to, I said I'd come back to it at the end, but let's jump into it now of why we feel potentially good about these down days. And as I look across the, stock market indices right now, I'm looking at, large cap, small cap, technology down 2%, 4%, 3% respectively, just about that, today. Mm-hmm. And that don't like to see those down days. I was thinking about this on the way in to do the show this morning before this news came out, just because I know the segment that we had prepared talking about last week, and how I was reminded of January of 2016. When I got a lot of calls from clients who were concerned when the market dropped about 4 or 5% in one day. And this was a time back in early 2016, the economy really started to look like we were out of the last recession. We had gotten through, some really good years. Unemployment numbers were down. We'd even see rates, have the whole temper tantrum going on. And so we really emerged at that point. It was like, well, Hillary's going to be the president and there's not going to be any major changes in the White House. It just seemed like everything was smooth sailing. And then all of a sudden the markets just panicked, and January ended up being a really bad month. And it was all because there was a new number posted for inflation, right? Where all of a sudden you started to see an uptick in inflation. And it just kind of speaks to how efficient I think the markets are that trade based on this data, right? And if you have things that are worth money in the future, right, that you're banking on as to support the price of what you own today, and all of a sudden something says that money that you're making in the future is worth less, right, then what you own is worth less, right? Those cash flows over the next 10 years are quite obviously going to be worth less if there's more inflation, and the markets will just program that in and react to that immediately. And so we can see that. And so we're seeing the markets react immediately to news coming from Jerome Powell, and what his thoughts are about letting inflation go. And then what that means to the current asset prices if that's going to occur.
And that makes sense why you mentioned that it's happening within technology and specific sectors where cash flows are way more are further into the future.
Further into the future. And valuations are stretched, right?
Correct.
And so you have higher multiples on cash flows, and so they're going to be magnified when those cash flows are worth less. But I think that if, let's say the Fed had taken different action and had maybe mirrored, what you saw in Australia and Japan and overseas, and had artificially tried to keep that long-term part of the rate cycle low, we'd probably be a little bit more concerned. I mean, some of these green days and the up days, right? We've been saying, hey, it's good. I'm not complaining that the sun's out and it's shining and everything's good, but we know that this isn't going to go on forever. And how long can you keep dumping gasoline on this fire, right? At some point, it's going to flame out. And so, I think some of this is really healthy in the long run for the overall economy, especially on when I see a day like today. Why the market's going down, I think, makes sense and actually is probably going to bode well for the longer-term investors.
Leadership changes in the short term. I think, let's think about the two concepts come to mind. One is where your focal point is. Are you looking 5 years from now, 10 years from now, or 5 minutes from now, or 10 days from now?
Yeah.
So sometimes what we're learning right now is the market is looking very short-term and reacting in a short-term fashion. Compare that to this conversation, which is around our Fed chief, and his viewpoint is very long term, right? And so
ours is,
it is,
as yours is listening at home. You should be if we're investing in the stock market, of course.
So we can talk about this idea of long-term, short-term as we kind of move down this line to these new segments.
We should move down this line. We've
gone
over time on this one,
Okay.
but it's been an interesting one. And hey, we weren't prepared to see the red today, so I think it's important to cover. But I think the next one is a quicker segment. We do have something. We'd be remiss not to say we do have a new stimulus bill, one of the largest government spending stimulus bills ever done in our nation's history. Which should be theoretically what happens as you go through, because that's how money works. But anyway, $1.9 trillion. It's being negotiated, going through the Senate, and looks like there's been some last minute revisions, but that it's coming.
And it's substantial relative to GDP. It's a huge percentage growth. It's supposed to take us to 4% rate of change, and basically it brings us above our trend line growth, based on our trend line growth prior to the pandemic. So if we didn't have stimulus, this is from the Brookings Institute, if we didn't have stimulus, we would maintain at a low level of growth from now into the future. If we have this 1.9 trillion stimulus, GDP growth rates can skyrocket and actually eclipse our previous growth trend that we set prior to the pandemic. So that's great news, which really brings up what's going on in the market. Again, good news is bad news is good news. That's where we are.
Yeah, and I think there's another headline that kind of has been developing over the last 24 hours or the last few hours where, you've kind of seen how the House, Senate, and White House are negotiating to get things done. We do have a 50-50 Senate, right? And so, there's not as much of a mandate, even though that's, gonna lean on the tiebreaker vote as the vice president. It's very narrow. So watching the compromises go through, I know there's some last minute revisions of who exactly gets the next stimulus checks. Millions of Americans were cut down. I think it was, pretty substantial, like 200,000 was the phase out for married couples. That's now down to 150. And you had, single parents had 150. They're down to 112.5. And I think it went from 100 for single down to 75. So
correct.
Pretty substantial change to who got the stimulus. And so that in itself is a note as far as who's getting the stimulus, how much gasoline is going on the fire, so to speak, which I think is good, again, for the long run. Probably not as good in the short run for some of our growth and risky, trades and that where if people have $200,000 of income and lots of extra money dumped into the bank account, you kind of see it make its way into cryptocurrencies and certain things that push asset prices up, right? And so I think that could create more fuel for a bubble. But anyway, I think the bigger headline too is just watching how the House and Senate and White House have to negotiate to get some of this stuff done.
Yeah, I think the bottom line is there's individuals that are in need. This pandemic has been pretty brutal for those without asset prices, and they're being very diligent on making sure that cohort of individuals receives stimulus, and that will find its way through the economy. And I think that's why we're starting to see potentially some concerns about inflation in the short term. And remember, in the 60s and 70s, the great inflation that we kind of all fall back on, consumer price index during the 60s was in the low 1%. And it didn't skyrocket to mid-single digits until like a solid 6-7 years. And so you did have variations on a month-to-month basis, which we're going to see, but it took a very long time for inflation to really grab hold. And that tends to be the concept that most Fed chiefs think about, is that inflation, while it can take hold, and that's very scary, or it was at least in the late 70s, it takes a really long time for that to happen. And that kind of brings us to where unemployment is. So remember, there's a dual mandate with the Fed. It's price stability and finding a natural rate of unemployment, or trying to keep maximum employment.
Yeah, and in strict inflationary environments, if you ask clients and those thinking about your past histories, you've likely done very well in times of inflation. The interest rate that you paid on your home was higher, but your home doubled every 3 to 5 years in value. And so you kind of see what inflation looks like. I think there's parts of stagflation that were really difficult, right? When you had inflation without rising asset prices and the pressure that put on households and economies. But, there's other factors at play there that, you and I were talking about earlier this week with, why Jerome Powell is comfortable with inflation. It worked for a very long period of time. In the past. So we've talked a lot about that in past episodes. I mean, it's obviously a bell we continue to ring, right, of how important it is to consider inflation and where you invest and, understanding that that's a big part of making sure you have a portfolio that's working in that environment.
Well, and so maybe segment now to why there's reasons to be actually really positive in this environment.
Yeah, so GDP revisions, so good days ahead, right?
Really strong days ahead. And Sierra, maybe you can put on the screen, we have a GDP Now chart just to kind of give a headline of, in the world of good news is bad news, and we can debate about that right now. So GDP Now is an Atlanta Fed estimate they put together. And instead of taking the poll of 30 of the proposed smartest people in the room, GDP Now just takes a regression model, collects data, and as the data comes out, it spits out a number. And it's suggesting that Q1 GDP 2021 will be around 10%, which is a huge growth number for Q1 2021, given that Q4 wasn't a bust completely. It's not like we just printed a -10.
Yeah.
And it's really interesting compared to the mean consensus here at 3%.
And who goes into that mean consensus, this blue chip estimate?
So they go through, and it's effectively a poll of some of the brightest minds in economics.
Okay.
And so, it's individuals who are forecasting and using all their data tools to create that consensus, which is different than a simple regression statistic that every month as it goes down, it changes. And looking through this GDP Now change, one of the major changes that happens was personal consumption expenditures, the change in the middle of the month, which is inflationary. So when we think about how money's flowing through the economy, we're handing out checks to individuals, they're going out to eat, they're buying gasoline. Those are showing up primarily right away in PCE, personal consumption expenditures. And so that is what's bringing this month-over-month change in inflation. The question is how sustainable is that? Will we have another 10% after this? Probably not. But really what we're doing is we're turning on the economy.
Yeah, and the economy is growing. Right? You talked about the ISM numbers before, and they're still above 50.
Sure.
Right?
So we just printed an ISM number. It comes out in the first day of every month, and we printed a 60.9 on the ISM. And 16 out of 18 industries were growing, and some of the numbers are just off the charts. So what we're looking at is things that you really want to look at within segments of an ISM are what are our new orders, how are inventories, how are customers' inventories, what's the backlog of orders and prices. So if you think about it, I'm thinking, how are my orders doing? They're growing. What are my current inventories? They're too low. What are my customers' inventories? They're too low. What's the prices I paid on my last batch of incoming goods? I paid a lot more. And effectively, what's the backlog? So I have backlog of orders high. All of those are off the charts high. Now, in the world of how Wall Street works, relative to how we might think about this here in this room, that sounds great. And it is good. It's actually really good information. But we're kind of in a world where Wall Street can look at great news and say, oh, good news is bad news. And that basically means that Jerome Powell, maybe he's going to take the punch bowl away. He's going to start rising rates because things are just getting too exciting.
Let's support that with some evidence. Actually, Sierra, I think we have another chart on PMI or the ISM manufacturing data, same thing. And nope, that doesn't look like it. But yeah, to your point, so we have the ISM reading. Nope, that's not it either. At 60.8, and which is near the peak, right? Which was 5 years ago in August of 2018, where it was 61.3. So if you think about the last time we had a reading like this. Was August of 2018. Now you recall what happened in September of 18 through the end of the year is the S&P actually traded down 19.8%, a 20% pullback right after getting this reading. Now, not to say those two are related, but I think to your point, right, is that this says that we are growing, right? And that's all good. That's also looking at what's just occurred, right? And so yeah, we are in a healthy economy. But the market does look through that number at other factors.
It does.
It also creates some expectations, right? Of when you're growing, right? There's a lot of expectations for that growth to continue, and so small moves like what we're seeing today that could upset that. The market is going to be oversensitive, and I remember that in 2018, just that consumer sentiment, how quickly that changed when it was just winds at our back, full steam ahead, sales are up, everything's good. And then all of a sudden there's this little, what's this trade war going on? And all of a sudden there's a 20% pullback in the stock market.
Right. I mean, this type of data as it comes in requires an element of digestion. Right? The market wants to get comfort with their future expectations. They think about things and can I see 18 months? Can I see 24 months in the future? How does that change?
Yeah.
And so as new data comes in that's as strong as this is, if you wanted to look at the other side of this, you could say, given this is a diffusion index, and a diffusion index means if I'm over 50, I'm growing. If I'm less than 50, I'm shrinking. At some point, you can't continue to grow faster every single month. At some point, even if you continue to grow year over year, at some point you reach a point where I can't say I'm growing faster. I'm just growing the same. And so your diffusion index will go from 60.8 back to say 52, maybe it even crosses the threshold of 50. An interesting research from Gina Martin-Adams from Bloomberg yesterday was that after seeing PMIs at such lofty levels, which we've seen 3 times in the last 25 years, you tend to have a 6 to 18 month consolidation in the market. And consolidation in the market would be exactly what we're experiencing. leadership changes, and effectively, value versus growth, financials versus technology. We're seeing that kind of happening, every day right now.
Yeah, and we do have still some growth ahead of us, obviously. If you look at where we were a year ago, kind of into the last segment here, if you look at unemployment a year ago, we were at 3.5%, right? Unemployment, which was, by the way, the lowest number we've ever had, right? It's the healthiest employment number. I think it might have hit 3.4 one month in the 60s. So we're coming out of the best employment number. And so at that point, you're seeing that ISM below 50 because, when how many more jobs can you create when everybody's working, right? And so you can have some inflation on wages and so forth, which, potentially we have. But today, that unemployment rate, I believe, is at 6.7%. So a long way to go, right? Or sorry, now it's 6.3, right? So we dropped from 6.7 to 6.3 in January, which is a good reading, right? So people are going back to work during that time. But if we're sitting at 6.3, knowing that a year prior we were at 3.5, there's still plenty of people to get back to work, which you could assume, right, Luke, that growth in the economy could continue.
Correct. With unemployment at that rate, you would definitely expect economic growth to continue. But so let's think about today at 6.5% unemployment, and Powell just said he thought maybe the real number was 10. He's continuing to press on the gasoline to get that unemployment number down. And let's take a step back.
What's the difference between the 6.5 and then the real number at 10?
So it's the way the data is collected. Right. So if somebody says they're unemployed, I say I'm unemployed. And the way unemployment's collected, the data is collected. If you leave the workforce, say, I don't want to work anymore.
Right.
For some reason, whether that's because you're going to stay home with your children or you have a partner who's making more capital at the time, you're now excluded from the calculation.
Yeah.
So what he's basically saying is that the number, if you take into those circumstances where people might be underemployed and therefore remove themselves from the workforce, natural, real unemployment is much higher, which really brings to tell you that our Fed is here to get unemployment down. And remember, 2 weeks ago we talked about the love fest between Janet Yellen and Jerome Powell. And, over the last 50, 100 years, the connection between our Treasury Secretary, our Fed chair, and even the executive branch has happened to connect and create major stimulus in the economy. And it happened largely in the 60s and early 70s, where there was substantial connection between those governing bodies to create growth. And I think that's what keeps me looking 12 months, 24 months, 36 beyond, is that there is a deep understanding that unemployment at this stage of our economy is a long-term problem. And they're working diligently to not only work to create that invisible hand that creates jobs, but to make sure that people who are unemployed have capital to have their basic needs. And I think that can't be overlooked.
Yeah, I mean, we had a better than expected jobs number come in today, and the market's selling off, right? And so we know that there's a lot of work to do, but it's interesting how closely it's reacting to what the Fed's doing. And again, over the long term, this is probably a healthy situation. So again, all of this stuff, right, doesn't really matter to you, right? All of the stuff that we're talking about in the stock market, this is just what goes on in the day-to-day, and what Luke and I are here to offer you our perspective of what we're seeing, read through the tea leaves, and what really matters as far as what's happening in people's portfolios, what is some of the information that we're looking at, and then try to give some context as to why the markets are reacting the way, so that hopefully you could go the way that they are. So hopefully you could go about your lives because, of course, all of you have diversified portfolios. You have a financial plan that uses time segmentation, that you understand when you're going to need certain assets. You're never putting yourself in a position to buy high and sell low, which allows you to be a really good investor, certainly during days like today.
Right, having a appropriate risk management, a tool that goes well beyond a qualitative measure, but using quantitative measures to create risk management. It allows me as a capital allocator to really look and have comfortable and stay focused on, how about March of 2022?
Yeah.
Like, what if you really just closed your eyes and thought about okay, the market's having its little tantrum right now, but what do you think the economy is going to look like over the next 6 months? Like, what do you think it's going to look like when you walk outside and view your neighborhood?
Yeah.
Like, what is an airport going to look like?
Well, I know how much has changed over the last 6 months. Absolutely. And I know that, 6 months ago we were talking about, I was talking to the camera in my guest room, right? And it was a different world. And so, yeah, 6 months could be a long time. And there's a lot of changes still at foot. California unemployment, by the way, is 9% reading, right? And so even here we have a lot of work to do and getting people back to work. So, yeah, and then Luke, you've been talking about this, the down and out trade, the reemergence of the non-stay-at-home trade, and we're just seeing new market leadership, which is something that you've continued to tell us about in these episodes, and we kind of see it playing out here. So be diversified, not having all of the eggs in one basket, and you're going to be able to benefit from that as new market leadership emerges, and so when we're seeing days like today where cryptocurrencies are selling off and, meme stocks are selling off and momentum selling off and technology selling off and, all these are all the things that just went up no matter what, right? And so now we kind of people have to get back to math. We've also been talking about what rising interest rates might do, right? When you now can make interest at a bank one day, what is that going to do to some of these extended valuations? And so we're starting to see interest rates tick up from 1.4 to 1.5, and we see some pretty significant reactions in the market. So I guess don't say we didn't warn you. But this is something that, we continue to monitor and watch and not overly unexpected. So anyway, I covered a lot today, Luke, and in short order with a lot of news happening. But yeah,
there doesn't seem as much time today for kind of the fun stuff such as Carol Baskin or other items. So.
Oh yeah, that was a good one. We got to bring back the call-in segment. If you want to do the call-in segment, please, we're going to send out an email. We'd love to hear you if you have any questions or topics that you'd like us to discuss here on the podcast. And of course, we'd always ask that you subscribe to our YouTube channel, and so that you don't miss any future episodes or podcasts. Go ahead and click that subscribe button, and you can follow Luke and I every 2 weeks, Thursdays at 11. And we'll keep you abreast of what's going on in the news, our perspective as always. Lucas, always a pleasure.
Cheers.
All right.
Have a good day.
Thank you, guys. Have a good one.